But we're going to talk IT now, leading up in the next few weeks to the IT guidance from Infosys for fiscal year 2010. Bhavin Shah of JPMorgan is with us now. Bhavin, morning. Thanks for joining in. Would you go in a little light on IT stocks into that guidance? Do you think it might be a very circumspect one from Infosys for the next fiscal?
Well, I think the guidance is certainly going to factor in the aspects of uncertainty. We would imagine that companies will, number one, be somewhat conservative, and number two, might even widen the range. But having said that, our sense is that the institutional investor base has sort of is sort of under an impression of assuming even as much as maybe a 10% year-on-year EPS decline. So I don't think there is going to be a big shock to the market in terms of the guidance. We have been cautious, in the near term for the space, given especially the March quarter trends are particularly tough. We can easily see a fairly sharp price impact, maybe as much as 5%. And that's why we think that in the near term there is limited upside potential. In fact, we would have thought the stocks might even pull back, although that hasn't happened. But yeah, I think as far as the guidance, our view is that it's unlikely to have a big negative shock at this point.
Bhavin, hi, morning. In terms of your channel checks with how business is progressing, though, how high would you rate the chances that some of these IT companies actually discontinue the practice of putting out a guidance and say things are completely uncertain, we'll get back to you when they are more clear?
Well, I think that might happen with some of the smaller companies, but I really doubt that companies such as Infosys or TCS are going to stop I think at least the annual guidance that you get. I think that will probably continue. As I said earlier, the range might widen, and in fact what seems to be happening with some of the customers is that yes, they are asking for price reduction, but the negotiation seems to be in the range of asking for also more volume, more offshore, basically increased volume to offshore. That trend seems to be actually certainly accelerating as a lot of customers face very high pressures on their cost structure. So I think while it's clearly a very tough environment out there, it is not one where the companies simply cannot give any guidance. So I would be very surprised if we don't get guidance.
What is your sense of how much by way of a pricing cut might have been agreed to by some of these IT companies?
Right. So the range of price reduction that is being asked by customers, we believe it's anywhere between 5% at the minimum to as much as 20%. However, it's not that the negotiations are concluding at 20%. We think that most of the price reductions appear to be in the range of sort of mid to high single digits. So I think that's where it seems to be working out. However, in exchange for agreeing to price cuts, I think in many cases the companies seem to be able to get additional offshore volume as well. So I think the volume, we could still see some bit of volume growth, or at least flat to slight increase in volume in next fiscal year.
If indeed prices are going to be cut by, say, 7-8%, Bhavin, how much of that can be offset by consequent salary reductions closer home so that it's margin neutral and does not show up in the profitability for next year?
Right. So, if you assume that, basically about, say, 5% cut in salary, that can essentially offset, a large part of the price cut that they're going to face. So I think we believe that up to 5% can be up to 5% of price cut can be absorbed by the salary cuts that we think that the companies are planning to take. So I think there is some margin impact, but again then there is the rupee benefit as well. So I think the margin story actually doesn't look too bad at all. I think margins could actually hold pretty okay.
The relative performance of the large cap names has been quite interesting, Bhavin. While Infosys is relatively far more stable between 12 and 1300, it's Wipro which is getting beaten out of shape. Any particular reason?
I think there might be some, customer-specific situations. Wipro's exposure maybe to customers such as UBS might be, having a bigger impact. So that is probably one reason. Second reason is just the sort of the preference for company that has managed to grow well even in a tough environment. So obviously that comes back to Infosys, who obviously has had the best track record in terms of delivering performance in a tough environment.
There has been an expectation, Bhavin, that come FY10 for a couple of these IT companies, there might be a positive pop because of what's been happening with the currency, hedging gains, etc. Would you say there could be a meaningful impact on any of these companies, and which one would stand out in that case to you?
I think in terms of positive impact of currency, I think clearly in terms of reducing the hedge exposure, Infosys has we've been most noticeable. Obviously Satyam was as well, but we don't cover Satyam at this point. But anyway, I think Infosys is perhaps most noticeable, so I would imagine that they benefit the most as well.
And what is it that you're picking up by way of budget spends right now, Bhavin? Because in our last few interactions with the IT companies, they've indicated that things haven't gotten frozen up quite yet. What would you expect to see in terms of a budget spend cut?
Right. So I think in some cases it's still on an ad hoc basis. There are no sort of annual budgets that are being planned. The situation is still sort of evolving on a quarter-to-quarter basis. But I would say that overall IT budgets are definitely going to decline anywhere from, I would say at least 10% decline we can assume for the, US IT spending by corporates. But however, that's a big pool of number, and there's a lot of things that go inside that number. There's obviously hardware spending, the salaries of the US-based employees. It all gets into that big number. If you look at the offshore portion, though, it is possible that offshore value could increase because I think at least in some cases we are seeing pretty significant increase in offshore proportion.
How will Midcap IT come out of this, Bhavin? While they may not give guidance because of lack of visibility, the way these stocks have been butchered these last few weeks, NIT, Rolta, Hexaware, is the market right in sensing that they'll actually not come out of this very well, nearly as much as an Infosys or a TCS may be able to negotiate?
I think at least in the next, a few quarters, these companies, the smaller companies, I should say, will face a bigger impact because we do notice that there is some bit of consolidation that is also happening. I think again going back to in order for the big companies to agree to a price cut, they're asking for more volume, and customers are in some cases responding by consolidating their vendor base as well. So I think that definitely puts the mid, small companies in a difficult position here. Obviously, ultimately, when we do get a more of a broader recovery, they can probably have a chance to, gain some more traction. But I think a near-term outlook for them is going to be tough. So, yeah, I think it's. I wouldn't, without going into specific names, I want to say every single stock has gone down, correctly or by the right sort of amount. But generally, the risk of weaker performance, outright declines, is pretty high for mid-cap space on a year-on-year basis.
Thanks, Bhavin, very much for joining in as always. That's the JPMorgan View on IT.